Well, good morning, everyone. Welcome back to the webinar. Nice to see you all. We're going to be talking today about South Africa and continuing last time's webinar where we kind of put forward the case that South Africa was heading into a better future. And we're going to talk today a little bit more about what we could do to accelerate that and fix some problems in our country, which have become all too apparent in the last couple of weeks. And I'm sure there'll be lots of questions around that. Important time for our country right now. Before we get to that, we'll get into markets as usual. So I shall share some slides with you. All right, here we go. Firstly, so markets still at record highs. They're kind of oscillating around their record highs right now globally. You can see from this chart that from the bottom, a very distant memory now. The global COVID crash, or GCC, as I would call it, back in March 2020. Markets have the US market has doubled since then. The NASDAQ, you can see in red, has demonstrably doubled and is really continues to lead the market at these highs, but it is kind of oscillating around those highs. So let's see how we go. What's driving it? Of course, vaccines. Kind of pre-Delta, kind of in the last week or so, the Delta mutation, Delta variant, I should say, coming out of India and causing some degree of havoc in the UK and soon in the US. But before Delta, vaccines were seen as the silver bullet, and a lot of people got vaccinated. We're up to, I think, 3.5 billion people globally. That's about half the world population. But of course, most of those are in the developed world. In the emerging markets, still a lot of progress to be made. And even half the world being vaccinated means only a quarter, because you've got to be vaccinated twice, as we now all know. But even so, lots of progress on vaccines, and that is powering markets ahead because we can see the light at the end of the tunnel. It's interesting, this chart, this is a little bit pre-Delta, I think. It's quite hard to see, but take a close look at it. In yellow, this is a chart for the UK. In yellow, it's daily new COVID cases. So you can see the last wave in the UK spiking, January 2021. And in kind of purple is the daily new COVID deaths. So you can see the last wave deaths were matching daily cases. So you get COVID, you get a lot of deaths. Now, in the latest wave in the UK, daily new COVID cases in orange, you can see spiking, but you can see the purple line not moving at all. So you can see in highly vaccinated economies, and we are seeing this in the developed world, you're not getting the same incidence of hospitalizations or deaths. That's not the case in South Africa. We are seeing very high incidence of hospitalizations and deaths in this latest wave, tragically, because we haven't got a vaccine program really going to the extent we'd like to as yet. Although we have vaccinated, I think, 8 million people now, which actually is quite good progress all of a sudden. So, but as I say, there's kind of a health warning around these because they are a little bit pre-Delta. We don't quite know where that's going to land in terms of this kind of a chart. So quite a bit of nervousness around markets just in the very, very near term. But in markets, we've seen continuing exuberance. This is an interesting chart. We've seen the largest inflows to equities ever in the first half of this year. What is that? $600 billion have hit the equity market. And you can see this chart goes back to 2002. So massive inflows into equity markets this year, and that continues to drive the markets in a rather frothy fashion. Other indicators of that, this is a chart of margin debt. So where retail investors invest in a leveraged basis using debt margin. And the incidence of margin debt is at, again, pretty much an all-time peak. And you can see previously when that happened, in 1999 and 2008, you got these big surges of retail trading fueled by debt. The market kind of went down afterwards. So 1999 was the tech boom. 2007 was the pre-crash boom. And markets really had a very tough time after that. We're at those same record highs in terms of margin debt right now. So that's a clear warning sign, I would say, for markets. And you can see in the near term, NASDAQ is overbought. This is a momentum indicator. And again, you can see this sort of goes back a year or so, but you can see the setbacks we have in the very near term when you get to these kind of very high momentum moments in markets. And then in terms of valuation, I found this chart very interesting and instructive. This is the tech sector in the States, or NASDAQ, basically. You can see that in the 1999 tech boom, then bust, the market peaked at a price-to-sales ratio of 6.8, and the tech market in the States is currently on 6.26, which is, again, a historic high. So clearly a lot of expectation in the technology market. In the broader market, yet another indicator. This takes a moment to digest. This is the real earnings yield. So if you think about the earnings yield is the inverse of the price-earnings ratio. So the PE is the price over earnings. The earnings yield is your earnings over price. So as a yield percentage as opposed to a multiple. So if the market's on 20 times earnings, then your earnings yield is 5%, for example. This is a chart of the real earnings yield. So that earnings yield deflated by inflation. And you can see that that real earnings yield is firmly negative on the S&P right now. And you can see, again, going back to previous peaks in the market, pre the 1987 crash, look at that. The real earnings yield was negative. Pre the 1999-2000 crash and pre the 2008 crash. And we're now at similar levels. So some warning signs in terms of valuation of the markets. And it is very concentrated in the US. This goes back to 1950. This is the US versus other markets. And you can see really in this last decade and a half now, the US has driven world markets higher and has outperformed almost all other world markets. And the last time that really happened was, again, the technology boom through 1999. We know how that ended. And then the Nifty 50, Coca-Cola, etc., in the 1960s, in the last consumer boom, or one of the last consumer booms. And that Nifty 50 was very narrow leadership of the market. And narrow leadership of the market happened in the internet boom, and again it's happening now with the FANG stocks. So the 5/6 stocks, Tesla, etc., Facebook, Apple, driving that market in a very concentrated fashion. Again, tends to be a bit of a warning sign. And finally on this, I think, again, I think a very interesting chart. This is the S&P 500 earnings per share, which is profits versus price. So the 7 years ending March 2000, which is again that peak of the tech bubble, it shows prices of the market, and the market grew 69% faster than earnings. So we had this disparity between profits growth and the amount the market was going up to the extent of 70%. And the 7 years ending March 2021, which is today pretty much, again, prices grew 70% faster than earnings. So again, that's an interesting potential warning sign. So what could markets be worried about? Because valuation is one thing, and kind of what's going on in terms of progression of themes is another. And the market, if it's going to worry about anything, I suspect it's going to worry about inflation. And this chart kind of sums it up. This is in purple, the US inflation rate. And in, yellow is the 10-year treasury rate. So the yield on the 10-year bond in the States is currently, well, this chart is 1.37. It's currently 1.2%. And inflation has spiked of late in the US to 5.4%. And that's been driven by a number of factors, which I'll get to in a minute. As you can see from this chart, inflation tends to track the yield on the 10-year bond, which kind of makes sense. Kind of around 1-2% generally. And inflation's broken out of that band. And the Fed is saying it's going to be transitory, but let's see. So this will be a big focal point for the market. So let's dig into, is inflation a problem and will it undermine markets globally? Not a problem in South Africa, by the way, but globally. Okay, so indicators. Second-hand car prices. We have seen this in South Africa as well. Second-hand car prices through the roof, particularly in the States. This is partly because of lack of supply of new cars, partly because new cars are full of technology and there's a semiconductor shortage, which is coming out of South Korea and Japan. So they can't source semiconductors, my friend in my car garage locally in Palm said, we're short of semiconductors, so new cars are not available. There are second-hand cars available, but you've got to pay up for them. So supply chain bottlenecks are causing part of this inflation problem. But people are having to pay more for second-hand cars. It's also prevalent in the housing market. This is a chart about rent levels in New York. Excuse me. The expected change in rent over the next 12 months has spiked from, what is that, kind of 5% to close to 10% in New York. So shortages of housing in big cities. This is an incredible chart. It goes back to 2011. This is the price you would pay for a container on a ship from, for example, Los Angeles to Shanghai, or Shanghai to Rotterdam, or Shanghai to Genoa, or Shanghai to New York. And it kind of hovered around $2,000. And you can see how those have spiked this year. So the price of a container now from Shanghai in China to Rotterdam in Holland is now $12,795 as opposed to $2,000. So that's a six-fold increase in the cost of transporting most of what we buy from made in China to consumed in Europe or the States. Supply chain bottlenecks. Big problem in terms of inflation pressures. And then also back in the property market, you can see how property prices have been rising globally. The blue line at the top is Germany. Germany's had the strongest property prices. Property prices didn't move in Germany for like forever, for 2 decades, 3 decades, and suddenly they're up like 70%. The second one is Portugal, partly because of the visa issue. Portuguese are welcoming people with visa enticements. That's up 40%. The UK is up 40%. Poor old Greece at the bottom is still floundering, hangover from the Eurozone crisis. But property prices are moving up, and we're seeing some fairly crazy things now. Look at these things in Canada. Okay, these are actual advertisements. These are in Vancouver, Western Canada. Very, very wet city on a sunny day. Okay, that house on the left is for sale for 7 million Canadian dollars. Give or take, that's about 80 million rand. I don't want to be impolite to it, but it doesn't look that great. On the right, 10.7 million Canadian dollars. Again, decent looking house, but 10.7 million, that's 120 million rand. But 10.7 million Canadian dollars is about 8 million US dollars. I mean, even for that market, that is crazy. So there's a lot of strangeness going on. Vancouver, partly the tech boom, of course, is very close to, well, fairly close to Silicon Valley, and access to China and Asian markets. So a huge influx of Chinese into Vancouver. And houses are as expensive, this is the OECD, so pretty much global developed markets. Houses are as expensive compared to income as they were at the peak of the housing bubble in 2007. More expensive, in fact. We've just broken through. That's an extraordinary statistic. So you've got very little wage growth, big housing price growth. You're seeing it in London as well, many other cities, Hong Kong, for example. That's a problem in terms of inflation. And this may be my final slide. I found this quite amusing. I think it's my penultimate slide on this. These are the trainers, sneakers, sorry, owned by Jay-Z. Jay-Z Rock Nation limited edition sneakers. I don't actually know quite what they are, but I think I know who Jay-Z is. And they just sold for $25,000 US for a pair of trainers. Sorry, sneakers. Tackies, which there's too much money around. There's too much liquidity. This is the Fed flooding the system with money. There's too much money in the system. We'll get onto that next. And the Fed is saying that inflation is going to be transitory. Again, I found this fairly amusing. So $23 Wi-Fi is temporary. United Airlines just put that up. It's going back to $8. I don't think it will. I don't think it usually does that. So will it be transitory? I'm not so sure. So I'd be worried about inflation. And there's too much money hitting the markets. Take a look at this chart. This is in green. Okay, fiscal stimulus as a percentage of GDP. This is the total kind of government money, checks to individuals, Fed money, central bank buying of bonds, everything hitting the market. That liquidity hits people's pockets at the end of the day in a fairly direct fashion. Okay, 2008, 2010, when they last flooded the market with cash, the US, that's the green bar, the US spent just short of 5% of GDP. 2019, 2020, just gone, they spent 12% of GDP. We talked about this before. The new stimulus on top of this, thank you, Mr. Biden, President Biden, is another 12% of GDP. So they're spending in total 25% of GDP over a couple of years. Canada the same. Japan, the UK, 15% of GDP. It's craziness. It's not craziness. I mean, they had to support economies, but it's now going on for too long, and it's likely to cause inflation. And it's putting money into people's pockets to a very large extent. So you can see excess savings here. This is cumulative personal savings in the States compared to its trend. So there's $2.5 trillion of excess savings in the States. It's about double that globally. So we've got $5 trillion, which is about 6% of world GDP, sloshing around, waiting to find a home. So you're seeing very strong retail sales in the States. Non-farm payrolls in the dark blue. You can see the collapse in employment, recovering a little bit, but not back to normal. We're still about 8 million jobs short in the States. Retail sales have recovered way above their pre-COVID trend. So too much money trying to buy too few goods. Not a great sign for inflation. And this is starting to come through into wages. People are finding it hard to hire workers. Again, this is in the States. This is the highest level ever of firms reporting difficulty in hiring one or more people for jobs. This goes back to the 1970s, probably the beginning of that survey, in fact. The highest level ever. And people are not really going back to work, A, because they're still a little bit wary about COVID, but B, because they're just receiving all this government checks, and they're still being supported, so they don't need to go back to work. So people are having to pay more to get their workers back, so wages go up, so the inflation becomes more entrenched. And this is a problem for the bond market. This is an interesting chart. On the x-axis at the bottom, US core CPI. So these are kind of dots of where inflation is. You can see that April, May, June, it's got 3% to 4% to, well, it's now 5%. And on the y-axis, the US 10-year yield. So the US 10-year bond, which tends to track inflation. You can see that curve. If inflation is kind of 4%, the long bond yield is about 6%, actually. If it's 3%, the long bond yield is kind of 4%. You have a slight kind of premium for the yield over inflation. And now it's like nowhere near it. So if the long bond does adjust to these inflation rates, it goes from 1.2% to 4% or 5%. We've got a big, big problem. And we've got a big problem because of all this debt. You know, all this money hitting the market has been funded by debt. US national debt is now 24 trillion US dollars. This chart is hard to see, but it starts spiking around 1990 when it was $2 trillion. It's now $24 trillion. I'll put it another way, as a percentage of GDP, we are still at historic highs. This was the post-war stimulus package in the 1940s. We're now at those highs again. So the debt servicing burden going up as interest rates go up could be a big problem. So to wrap up the markets, are high stock market valuations justified? Well, they are very high, that we can say. On the left, price-earnings ratio back to 1928, and the 1928, 29, 1930 crash. We are higher than that today. And on the right, price-to-revenue ratio. Again, this goes back to 1947. We are at all-time highs in terms of price to sales. And what you can say about markets is that when you get to these kinds of levels, your 10-year future returns are fairly subdued. So this is the chart that shows that. So if you look at the x-axis at the bottom, if you're at like 11 times PE, you get a return of 20% per annum for the next 10 years. So you buy the market cheap at 11 times, you get 20% per annum for the next 10 years. Happy days. You buy the market at 22 times, where we are today, and you get 0 per annum for the next 10 years on average. A couple of interesting charts. So to sum up on that, let me pause you from the charts for a second. I guess to sum up on that, near-term caution on the markets. Again, that Old Mutual, we're actually very well invested. We're riding this wave. There's a lot of liquidity pushing markets up. At some point, we'll have to bring that down. So some near-term caution. Markets are high, and particularly global markets are high. South African markets actually a lot cheaper. So more safety domestically than offshore right now. And I made the case last week for a stronger South Africa, a stronger rand, more domestic activity. We still believe in that. So SA versus the rest of the world is actually in good shape. The rest of the world, particularly the US, needs to come down a little bit. That's the message. Let's spend a couple of minutes on kind of longer term effects post-COVID. This is a chart which has become quite famous as kind of the chart of the century. It shows you inflation, actual inflation, in major parts of the economy. Again, in the US. So back to 1998, what's become more expensive, what's become cheaper? At the top, what's become more expensive? If you cast your eye down those, it's three categories. Healthcare, education, and housing have all become much, much more expensive. So outside of housing, healthcare and education, service-led areas, not manufacturing, particularly domestic, and where the government gets involved. The government gets very involved in education, clearly, and it gets very involved in healthcare. Prices have gone through the roof. At the bottom, particularly at the very bottom, cell phones, computers, toys, TVs, anything manufactured, globalization, manufactured in China, imported into the US, anything manufactured and anything tech-related has collapsed. So this is only going to accelerate from COVID. E-commerce, technology, prevalence of technology in other parts of our lives, particularly healthcare, and also education. We're going to move to an online education world. So you can see how the benefits of lower inflation could migrate to the top of this chart, which would tend to fly in the face of higher inflation in the nearer term. So structurally, you could see a benefit in terms of lower inflation in those upper categories. Cheaper healthcare costs, cheaper education. We're already seeing it. Prevalence of online education. Housing, not so sure, actually. But outside of that, you could see some beneficial effects, actually, from COVID. Not so beneficial is the next chart. This is an awful chart. This is the combined net worth of billionaires worldwide on the left, and on the right, the number of billionaires worldwide. And if you look at the last chart, 2021, the number of billionaires worldwide has basically doubled in the last 12 months. That's extraordinary, from 1,500 to give or take 3,000, $13 trillion. And what's happened is a lot of this Fed money has hit assets. It's hit equities, it's hit boats, it's hit classic cars, all these things rich people own. So your asset base has gone up, so your wealth base has gone up. Your income has been depressed. So if you're starting as a nearly billionaire, you've doubled your wealth in the last 12 months. So the share of the spoils is not improving as a result of this Fed stimulus, which, by the way, wasn't necessary to support economies. I get that, but it's hitting the wealthiest in a much more beneficial way. And that's true of a lot of the COVID effects. Another way to look at this is the wealth of the top 0.0001% of the US. And that 0.0001% is the 18 richest families in America today. It was the 4 richest families in 1913. And you can see how that, again, has exploded. It's now 1.4% compared to 0.2% in 1988. Yeah, so massive concentration of wealth. I don't see that going away. In a technology-driven world, that's going to be a problem. And finally, I had one slide on Bitcoin, crypto. I love this one, tongue-in-cheek. I used to have to wait until Monday to lose money in the markets. But thanks to cryptocurrency, I can now lose money all weekend long. Because you can trade Bitcoin all weekend. And Bitcoin has come back down as predicted. I think we'll head to 20,000 or below. It then may or may not become interesting. We'll see. We'll update you on that. So markets are very emotional at the moment. So mind your eye, lots of volatility and the madness of crowds. Okay, we've got 10 minutes, maybe 15 on South Africa. Let's look at that one. Oh, we've got technology first. I'm going to be very quick on these. Richard Branson went to space. Very exciting. And why is that important? And it's very, very pretty craft. Why is that important? Because you'll be able to get around the world very quickly in these kinds of spacecraft. And Jeff Bezos went to space, kind of proper, and that'll mean with SpaceX, more mineral mining in space, cheaper minerals, and less trouble for planet Earth. I'm going to skip these because I'm a little bit short of time. We've got 3D printed steaks. That sounds like a bad idea for South Africa. Less frying. Ooh. And the world's third 3D printed office in Dubai. I thought that was interesting. If you have an implant in your brain, then it could remove pain. That's interesting. And then finally, they've grown a heart in the lab, which can pump fluid like the real thing. Let's get to South Africa. We'll take a short break. We'll spend 10 minutes on this and take some questions. Okay, South Africa, we made the case. Strong foundations, I'll go through that. Some recovery in the economy. Better terms of trade. Commodity prices very beneficial. And some movement in terms of the political will to make things happen. We'll come back to the awful riots as you wish in terms of questions in response to that. Let me run the 3 slides on this. Okay, I'm not going to list these. You can kind of glance down. I think we all know this, but it's worth remembering. We do have a stable democracy. It doesn't feel that way quite a lot, but we actually kind of do compared to most African countries, dare I say. We have entrenched rights and a free media, great constitutional court, which has just proved itself just about, again, widely accepted rule of law, sensible independent central bank, a very strong financial sector, actually a very robust corporate sector, and very robust and deep capital markets. Mineral wealth, we have tourism potential, I'll come back onto that. So there's a lot to be said for South Africa, which we sometimes forget, but also a lot which is bad. This came out as quite small print. I do apologize for that. I thought it'd be bigger. This is the Social Progress Index. And if you can see it with good glasses, then what it highlights is the very difficult areas. Very high child mortality rates in South Africa, very poor sanitation, awful shelter, very poorly rated for personal safety, and traffic deaths. Really. Access to quality education is bottom of the pile globally. Access to internet is pretty poor. Access to mobile phones is number 1 globally. We've got more mobile phones per person than anyone else on the planet. So that's actually helpful in terms of online provision. Access to quality healthcare is very poor, and advanced education is very poor. So number 1, basic foundations, we have to, I'm not going to dwell on this, we have to improve education, housing, sanitation, healthcare, the rule of law, please, and basic services. Those are, we have to solve those things. There are many ways to do it. I'm not going to get into that. Those are the obvious ones. Let me list some things which may be maybe a little different. 2 slides. Number 1, domestic economic growth. We need to focus on growing the pie and stop carving it up. We spend a lot of time discussing how to split spoils, and we need to focus on how do we grow our economy. Part of it is labour market reform. We need a lot more flexibility in the labour market. We need to be able to easily hire people, and dare I say it, easily fire people. Because unless you can easily fire people, you don't hire people. And that leads to sclerosis in the labour market. And it's a pandemic in South Africa. We have to have more flexibility as the most successful economies have in the labour market. We need a privatization program. I'm very heartened by the SAA news. I'm not against public provision at all, but when you privatize things, they tend to become more efficient. And if you can get that kind of public-private partnership right, that can be incredibly powerful. We need to do that across the public sector to the extent practical. We need a competitively fast internet. I think SpaceX can probably help on this. We've got 20,000 satellites. Elon Musk has got 20,000 satellites in space, beaming down internet provision. That's going to go. It's going live now. We need to plug into that. We need to get internet for people because the provision of internet is catastrophic in this country. But people have got mobile phones. They've got the hardware. They just need the internet into it. That would be a game changer. Tax-free zones for commerce. We need these successful commercially minded hubs, which have proved very beneficial in many other economies like Dubai, like Hong Kong, you name it, like the States. Tax-free zones for commerce. We need to expand and liberalize renewable electricity or energy. That's starting to happen. Very encouraged by the latest program in that. And we need to ideally digitize economic activity. We can make this leap now. If you go to Dubai, okay, you pay all your bills on your phone. They're listed: water, electricity, gas, whatever it is. And you just pay them to the state on your phone. There's no like written bills or anything. It's not that hard to do. If people do have phones that get the internet to them, then we can get like Kenya with M-Pesa. We can use it for money. We can use it for bills. We can use it for e-commerce. Digitize economic activity. Make that leap. Be visibly tough on corruption. Get people in the orange jumpsuits. We're starting to see that happen. Encouraging. Control public sector wages. I'll say no more about that. Half of our tax bill goes to pay public sector workers. I'm not against public sector workers. But let's get that under control, because it's taking too large a part of the pie right now. Link pension fund investment to local infrastructure. There needs to be sensibly packaged infrastructure programs which pension funds like us can invest in and make a decent return and invest in our local economies. That linkage is critical. It's the best way we can make an impact for our nation with our own savings. We're working on that on the financial side, and government are working on it. So I'm hoping that linkage will become cemented. And please, let's make public sector services more efficient if we can. I see the queues outside Home Affairs in Paarl, in Franschhoek, in Cape Town, and they're round the block twice, 3 times, and those are people who are not working when they could be working and doing productive things. So they're queuing for 4 hours. That's a tragedy. It's just about efficiency. It's not about money. Okay, that's the domestic piece. That's my wish list. Final slide. I'm going to move on to questions, which I can now see coming in. SA on the global stage. This is taking SA into a meaningful and contributing nation globally, which we absolutely can be, because we have the talent across the nation. Let's remove all foreign exchange controls. They're less than they were, but certainly the perception overseas and the reality often is that there are clearly restrictions in terms of how much money you can take in and out of the country. Remove all those. The government are petrified that if they remove them, all the money will leave. It'll be the reverse. If they remove them, money will come in because they know it's liquid enough to leave again. So the UK did it in the 1970s. Sweden did it in the 1980s. It transformed the economy. Money flowed in, not out, because it knew it was safe to be there. We are an affordable global creative hub. Manufacturing or service level provision, given the global reach everyone now has, is so much cheaper to do in South Africa because we have a cheap labour force. We just do, because we're that kind of economy. Technology development, app development, blockchain, TV and film industries here, advertising, design, fashion, they're all kind of here. Let's support them and create these hubs for them, because people will locate here. They film US series here all the time because it's much cheaper here. So let's make use of that and sell globally. I've worked in London, Dubai, and Cape Town. Strangely, London is the Northern Hemisphere hub, which links East and West, geographically very well located. It's part of the reason for its huge success. Dubai created itself as the Middle Hemisphere hub for trade and tourism. And again, geographically very convenient, but it deliberately did that. Qatar is starting to do it again now. So the Middle East lives midway between the West and the East. So do we. We can be the Southern Hemisphere trade and travel hub. Flight connections, ease of airport use, trade links, open up these routes. These ancient routes which used to exist with India and Australia and China 800 years ago. Let's open them up again. Let's link with Latin America. Let's make that the hub. And then we'll become the natural gateway to Africa, which is what we, of course, should be. And please, let's have a proper offshore PR campaign. When I'm in London or New York or anywhere else, all I hear is bad news about South Africa. That's all we have. And I see adverts about how great Greece is or how great Turkey is, because they have a deliberate PR campaign. And it's just glossy adverts. That's all we have to do. We have nothing. Nothing. And it drives me crazy. So we're shooting ourselves in the foot the entire time because people are afraid to come And let's link to that. Let's have an accessible visa program, which can attract people on a tourist basis and on a permanent basis, where we can create and build on our talent base here and really become a great nation again. It's all there. The potential is all there, and I must say I am encouraged with the progress we're making, albeit slow. And let's see if we can do better on that. That's my wish list. I'm glad to share it. Let's take a question. Okay, from Sean. You say SA is less risky as a market, but if developed markets retrace, will that not bring SA markets further down? If so, what are you doing to protect capital? I think it's a very good question. And I need to preface my comments. So in the near term, we have issues with equity markets. And there is a risk they will reprice downwards. If that happens in South Africa, of course, we'll get caught up in that. In the longer term, it is a truism and absolutely a fact that for all clients, it is best to be in a multi-asset fund, which is a mixture of equities and bonds and cash. And a healthy dose of equities is absolutely the right thing to be in SA and offshore. That mix is correct. So the 10-year view, you're saving for retirement, stick with that. So in the near term, we may get that drawdown, or we may not. I may be wrong. That's certainly possible. But on the 10-year view, a multi-asset portfolio is absolutely the right thing to have. So don't worry about that. You've got to ride these things through. Where can one kind of hide, let's say, in that kind of thing? But you can hold more gold, you can hold more silver, you can hold inflation hedges, index-linked bonds. We're starting to buy more of those within our multi-asset portfolios. So there certainly are areas, and cash has become more attractive. The South African bonds are very attractive, yielding 8%. Corporate bonds in South Africa, very attractive. So plenty of places where you can get that balance a little bit tweaked, which is part of what we are doing to protect that capital. Next question. Is it still a benefit to buy Bitcoin? I'd say not. I'll repeat that. Is it still a benefit to buy Bitcoin? I would say not right now. I'd like to say we kind of called it on the way up, and I'm slightly pleased by that, but and we kind of called it on the way down. It's now gone from 60,000 back to 30,000. And let's say we get 3 times lucky. My call right now would be Bitcoin below 20,000. So until it gets there, let's not think about it. Ethereum is the more interesting longer-term coin anyway. And the longer-term play is that Ethereum will be worth more than Bitcoin in 3 years' time, because it has more efficacy for the blockchain, so more actually use case than Bitcoin. And there is a risk that nation states just say, no, we're not going to have cryptocurrencies, because one of our main levers for economic and population control is control of the money supply and control of interest rates. And we are not going to give that up. And they could just ban crypto. That is an existential risk which you live with in any cryptocurrency discussion. So let's wait for it to come down. Again, I may be wrong, but my view is let's wait for it to come down before we make any kind of call. Another question elsewhere in terms of risk factors. Of course, the awful riots last week and tragedy. Clearly, from all points of view, I'm not going to get into that, and I know we all feel that very much as a nation. From an economic point of view, from a market point of view, it didn't have much impact, actually. The markets felt it would pass fairly quickly, which is pretty much what it's done, I think. And we need for our president to come out strong after this, and I hope he does. And I'm hoping that in a month or so's time, people will say, well, actually, the rule of order just about survived, and our foundations were intact and actually helped to get us through. And people will focus on those as opposed to the near-term troubles. But they are sourced in lack of opportunity and lack of money, and we have to solve those things, which is part of my wish list, I hope will do, which will grow the pie for everyone, which is what we need to do. Next one, we're almost out of time. If inflation is a certainty, what assets are you investing in at this point? It's a good question. I wouldn't say inflation is a certainty. Nothing is a certainty. But I get your question. I'm certainly worried about it. I'm worried it's a little bit more sustainable than the Fed is saying. And the Fed does want higher inflation, by the way, because they need to deflate the debt load. So in that world, the list is gold, silver, potentially Bitcoin, but not right now, inflation-linked bonds, particularly probably domestically, SA assets, I think are attractively priced still, particularly bonds, and we're not going to get the same inflation problems in SA, and real assets, which tend to be inflation-linked, like infrastructure, like real estate, actually. So if you can get access to those infrastructure-type assets, which you can in some funds from our competitors, that's an interesting play. So those kind of assets is kind of an inflation hedge as part of your portfolio. And I would say this argues definitely for a pro-South Africa view compared to the rest of the world, which we've been saying for 12 months now, and thankfully it's been kind of right. We expect it to continue to be right. So that's not something you can say every day. So that's I think quite a nice thing to say about it. Okay. I think I'll sum up at this point. Thank you for the questions. Thank you for the session. So a little bit of caution on world markets continuing. SA is more attractive as an investment destination generally, from all points of view, from its valuation, and we're not going to have the same inflation issue which offshore might have. So the rand, we think, will actually be strong over the next, 12 months, 6 to 12 months. And South Africa has an enormous opportunity right now. And I'd love the president maybe to look at our wish list and actually do something about it. And I really hope he does. And I hope they have the political will and wherewithal to do it. So thank you very much, and I will see you next time.